Good afternoon, everybody. I'm Aaron Norris, Vice President of the Norris Group, and I'm joined today by Craig Hill, the loan officer here at the Norris Group, and Bruce Norris, the CEO. Just a brief introduction to the company if you're not that familiar with what we do and who we are. The Norris Group actually has two very distinct divisions here. We have a real estate investment side where we actually fix and flip and build new homes. We've been around since '97, but CEO Bruce Norris has actually been doing the real estate property buying, fixing, and reselling business since 1980. In the mid 90s, he ran into Craig Hill looking for some extra leverage to continue to buy more houses. That's how they met. He was at another company, and in 1997, Bruce decided to open his own company and hard money loan division. So in 1997, that's when the Norris Group officially started as a company. So one side is the real estate investments, and we have the hard money loan and trust deeds division. We loan to professional real estate investors in various ways depending on their projects and what they're trying to do, from fix and flip to buy and hold as rentals and also new construction. And another service we provide for our network is investor education. One of the things that the Norris Group is most known for is market timing research. Through various experiences and downturns, Bruce Norris decided in probably around mid-1995 to start research, trying to find out if he could predict some market trends, getting stuck in the last bust in the 90s. He was a little frustrated that he didn't really have a warning. So in 1997, he put all his research together in the California comeback, where he predicted that prices would double in the following 7 to 8 years and would see even greater price appreciation if we saw a sub 10% interest rate, which of course all came true. Then in 2006, he wrote the California crash, sort of putting us on the map again with the prediction that California was going to see massive price declines, and he made a lot of people money in 1997 and helped save a lot of people money in 2006. And actually on July 13th, we have an event called California Comeback 2, where he's predicting some pretty ferocious price declines over the next few years. And it's a 280-page report with 350 charts. We take our research pretty seriously. So it's just one of the services we provide our network with ongoing training every year and a half or so. Another thing you might not know is we have an award-winning radio program that we've been doing for, I think, over 6 years now. We also turn it into a podcast, and we interview world-renowned economists, association presidents, and real estate thought leaders. We get them on for about 25 minutes every week on the weekend on KTIE 590 AM out of the Inland Empire, and then we proceed to podcast that information, and you could actually listen to any of our radio shows all the way back to the very beginning on the website, thenorrisgroup.com. So we've interviewed the FBI, Fannie Mae, Freddie Mac, presidents of the Appraisal Institute, the Mortgage Brokers Association. We just really get a lot of great information, bringing the most vital information to our network so they can make great investment decisions. That's actually turned into some really cool things. We got to go to Washington, D.C. a few years ago. We ended up doing a lot of advocacy work for investors. We think investors play a vital role in the economy. And in the real estate sector, we got to talk to Fannie Mae about the role that we think investors play. And we'll also do something called I Survived Real Estate. October 18th, 2013, it'll be our 6th year. We've raised almost $350,000 for charity. It's a black tie event at the Nixon Library in Yorba Linda, California. And we fly out different thought leaders, economists from all over the country, talking about their different sectors, how to succeed, regulation, legislation, and we make it available online. You could actually see more information on our upcoming event at isurvivedrealestate.com. With that, I'm going to hand over the session to Bruce Norris and Craig Hill. They're going to talk about what hard money loans are, get into some of the different programs we have, and answer a lot of the frequently asked questions that we get on a regular basis. With that, here we go.
The term hard money, can you just briefly describe what that means?
Yeah, I think hard money, simply put, it's just a way of it's private investor funding or what have you. So hard money is the term that describes, you're not using a bank, a credit union, anything like that. Hard money is just it's somebody that wants to borrow money, and then the lender is going to be a private individual. So
okay, and there's restrictions, let's say, on a standard lender that really the hard money loan business doesn't have to adhere to do safe loans. So our clientele usually buys homes that need work.
Exactly.
That's very common, and normal lenders would say, well, that's not a that's not a loan I want to make, where for us, that's the perfect loan to make.
Yeah, we're fortunate. Years ago, probably 25 or 30 years ago, I did conventional loans, and unfortunately, you couldn't use common sense.
Exactly.
So
That's what it boils down to, is hard money in the right hands is a common sense lender going, what are the odds that we're going to get paid back and get paid monthly? And our track record basically says we have a good grasp on when to make that yes decision.
exactly.
Who is the typical borrower of our hard money?
Our typical borrower, there's a couple versions, if you will. The first version, basically all of our borrowers, with the exception of a few, they work in the real estate industry. So they're buyers that maybe buy fixed properties and resell them, or they're borrowers that buy fix-up properties and then hold them for rentals. The normal person that we lend to is probably somebody that has a lot of experience doing the business. Our requirement of, we really want to see the liquid cash. So our borrower is going to have experience, generally a lot of liquid cash. We are going to look at them in terms of credit, but once again, not necessarily as important as liquid cash. If there's something current on the credit, like major bankruptcies, things of that nature, of course it would prevent us from doing the loan. But once again, they're very experienced, usually have a lot of liquidity to them, and this is what they do for the business. That's the primary borrower that we deal with.
And I think because of the nature of what their business is, they become repeat clients.
Yeah, if you were to look at our loan list, month to month, probably 80 to 90% of the names, if not more, that appear on the list are repetitive clients.
Right.
So when going back to that owner-occupied conversation, with that type of scenario, you're kind of one and done. So that person doesn't have much of a commitment to you. Our borrowers, some of them probably do 20 deals, not all of them, but 20 deals plus, if you will. So if they have that one situation that might not work out, if that's an owner-occupant in that situation, you're kind of left on your own. The owner or the non-owner investor client that we have, as you mentioned, they view us as a business partner almost, and they're going to protect that. Say that one property or that one deal, just because they're dealing with us on multiple other deals. So it's a very good incentive for them to keep payments current. And as you know, if somebody gets in the system and doesn't make payments, that's just not somebody that we'll ever deal with again.
Right. One thing I like about trustee investing for myself, it was easy for me to understand. So I have lots of trustees at this point, and the basic concept is the person becomes the bank. And that's a pretty easy concept to understand, because most of us have borrowed money from a B of A or FHA, and in this particular case, we're on the other side of the table.
Exactly. That's exactly how I explain it to people. It's certain investments maybe aren't quite as easy for people to understand, but almost everybody at one point or another maybe has bought a home, so it's just a very simple transaction for them to understand.
When we as a broker, we've been in this business now for over 15, 16 years, we have a whole group of people that talk to us every day about, I need funding for something. Explain to participants, we have somebody that wants to borrow money, someone with money, and a broker in the middle. First of all, why is that really the best situation for the beneficiary, the person with money, to get involved with?
Well, there's several reasons. So we've talked about this a lot. So if I forget one, go ahead and chime in when I'm done.
Okay.
But the first one, interestingly enough, the beneficiary can actually get a little higher yield if they go through a broker than they can if they're trying to do it on their own. So that's one advantage. I think the most important advantage, though, is when you're going through somebody, they have experience. Just us alone. I mean, I kind of wrote down some numbers. We're on our 3,782nd loan that we're doing right now. So you're able to buy into somebody's experience, because picking a trustee isn't all just, looking at the front lawn and trying to make an assumption, or the house, is this a good trustee or not? There's just so many aspects that go into picking a good trustee. So
yeah, you and I know so many stories of people that have gone out on their own thinking they're going to increase their yield, and they've really basically ended up with a job that they're not very good at.
Exactly, and I kind of use this as an example. I mean, you talk loan to value, and if everybody's familiar with that, basically loan to value is how much you're going to lend, versus what the house is worth. And simply put, you could show somebody a deal at 50% loan to value that maybe on the surface appears safe, but if you really look at it, it's not as safe as one at 65% with all the other right circumstances. So, people tend to try to, make decisions on something, and once again, they don't necessarily, have all the information or the tools that we would have to get them a good qualified trustee.
Well, that's the other thing. If they were trying to get them a trustee funding themselves, it would be one client randomly calling them, who maybe have been turned down for really valid reasons from someone with experience, where we are called by dozens and dozens and dozens of people a month. And I think it's important for people to realize that we say no a lot. Before they ever hear about a trustee opportunity, we've said no to probably more people than we say yes to, just because of something is missing in the process. And that's that part of detective work, and having a team that protects everybody's interest, not the least of which would be our appraisal.
Yeah, I mean, it's from step one to step two. You brought up an interesting point. I mean, if I get a call from somebody that's a new client to me, obviously so many are repetitive, but if they're new, one of the first questions I ask them, have you done it before? And a lot of, oh yes, I do this and that. And I'll say, well, how have you been funding them? And a lot of times they were with the lender, or for some reason the lender won't lend to them. So there is a lot of detective work, and as we've talked, when you have this conversation thousands of times, you really get familiar with kind of what to listen for, and narrowing down who's going to be the good clients. And as far as saying no, I'm sure all the borrowers would say I say it way too much, but with new clients, I mean, we must say no, 5 to 1, if not more. Just making sure that that the deal is one that makes sense, and the borrower is somebody that can afford to be doing it.
One of the things under the definition of hard money is that the interest is higher and there are points. Are fees ever paid by the person with the trustee investment, the person with the money?
No, the person on the funding side, the investor, they don't pay any fees. The only, say, exception to that might be if they're using their retirement account, self-directed, something of that nature, and it wouldn't really be any fees associated with what we're doing. But sometimes there is a fee associated with using money in your retirement account.
But basically points and all the escrow fees and title and stuff, that really doesn't come out of the person with the money putting up their money for a loan. That all comes on the borrowing side.
Yeah, that's all paid by the borrower, yes.
Okay. The security that really the underwriting process, I guess that's important for us to discuss, is that you mentioned that we have a lot of experience, and even prior to you coming on with the Norris Group, you had lots of experience that you brought, and we have a team of very experienced people, and that's, I think, one of the most important things that we offer, is that we've been around now for a long time, and we've seen a lot of things that we know, okay, well, we're not going to do that, and here's why. Even though this particular loan might be safe, that group, as far as we're concerned, is going to have a problem. So we stay away from that type of thing. And I think one of the things that people need to realize is that we really do want people not only to have some cash in the deal, but you're very careful about what's left to take care of the surprises, the borrower liquidity.
Yeah, it's mandatory, and I kind of go back to one. This is, 10 years ago or longer, but I remember a client that, it was a very good deal, but it happened at the time the market turned, and they were kind of like, they paid like clockwork. They had the deal in escrow, but the market changed a little bit. And, their house didn't sell, and I actually got after getting an email a month earlier thanking us for, how everything went, they actually sent an email saying they had exactly this much like allocated to this deal. And they had went through all that. You know what I mean? So it was
Right.
kind of like they reached their limit, and they weren't really people that were, full-time investors. And once again, that's the advantage of dealing with full-time investors. They're prepared for those circumstances. And probably the most frustrating thing for borrowers that call in that get told no are people that might have, and this might be a surprise to some of the people on the call, but somebody might call in or send in a deal, and they might have an 800 credit score, and maybe only 30 grand in the bank, or a home equity line for 20 or 30,000. A lot of times, depending on the deal, I mean, that person is told no just because, as you mentioned, they're just not prepared for all the scenarios. We don't do a deal based on the fact that it's going to go well. As you know, and I'll probably maybe touch on that later, it's such a large percentage do, but we're definitely looking at it as, are we lending money to somebody that can handle the situation if it doesn't go well? Because, as you know, everybody's happy when the deal goes well.
Right, and I've been an investor for hundreds and hundreds of properties, and almost every one of them has something that pops up, something that was a little bit more expensive to fix or takes a little longer to sell. And let's talk about our repayment history. I mean, we have a pile of about $60 million worth of loans currently, and way high into the 90 percentile are current. And that's with an interest rate that could be, over 10%. That surprises most people, but that's been very consistent during our whole history.
Yeah, it really has. And one thing when people come in is and you've seen me do this, I'll just pull up my computer and show them the history of all the loans that we have working. As a matter of fact, I actually kind of just pulled this up because this is a frequent question. As you mentioned, we've got a portfolio now of right about 60 million. The loan number that we're on now is 3,782. Out of that portfolio, we have one loan that's in foreclosure. It's number 2884. So as you can see, that's about 1,000 loans, and we have one that's in foreclosure.
Mm-hmm.
And then the one before that, that one hasn't actually gone to sale, but it's scheduled to in a couple months. The last one that we actually had go to trustee sale was loan number 2466, and that one was actually originated in October of 2009. So, there's never a guarantee of, because that gentleman was in a seminar one time, I remember, and we talked about our, our track record, and obviously there is one now and then, but overall, the process that we go through and the decision making has really been very successful for us.
And just because a property goes through foreclosure process doesn't mean it creates a loss for the lender.
No, absolutely not. The one, the last one to go all the way through, he actually got all his principal and advances and everything out, interest included, and most likely the one that's in foreclosure now, if it's in escrow also, so they're kind of it's in escrow and it may sell before it even goes to sale, but with the way the market is and the numbers on that one, I doubt that if that goes to sell, it will even somebody will buy it at the trustee sale, I'm sure.
Yeah, absolutely. And I think that brings up the last point is one of the things that a hard money loan business does is make sure there's equity for the lender. So what are the loan to values that we're typically looking at?
Yeah, typically our loan to values, Bruce, we're going to be for most clients around 65% of the after repaired value.
Okay.
And for people that might not understand, once again, after repaired value would mean when the property's fixed up. So what we do is we have the appraiser who Rick does our appraisals, and he's bought and sold over probably 200 or 300 homes himself, so he's very experienced. But we do an appraisal based on what the house is going to be worth when it's fixed up, and we hold funds to accommodate for that. So we'll generally lend about 65%. Some cases for the best clients we have, it's probably a little closer to 69. Maybe some properties or some clients, it might be more around 60. But there's always going to be cash in the deal regardless of the loan to value. And a lot of it, you had touched on earlier, the fact that, you know, I think everybody would just agree as far as market timing in the industry in California. There's nobody that's even been half as accurate as you are. It's very beneficial from my seat because, you know, we're talking about loan to values today. We're in a market where when you do an appraisal, you're looking at houses that are maybe comps that are 3 months old.
Mm-hmm.
Well, in a market that's going up, you're a little more aggressive on the loan to value. If we were talking, 4 years ago, the loan to values would probably be 10% less than what we discussed. So once again, it's always a fluid thing where you're at. Right now, we're in a very good position because if somebody buys a house, we're probably looking at comps that were 3 months old or so. Mm-hmm. They sell it 3 months in the future, so you have like a 6-month appreciation almost before that person sells the house.
Yeah, it just naturally when the real estate market starts going up, the trust deeds that start at 65% don't end up there.
No, generally not.
They end up with more security. The next topic is who invests in trust deeds, and there's quite a list here. Who's the top 2 categories for us? Who invests in our trust deeds?
I would say the majority, say just of the funds, they're people that are business people, maybe have sold businesses or something like that, and they really don't want to be involved in the time it would take to get that kind of return. So they're mostly passive people, that have been successful, that have done that. There's a large group also of people that either are retired or close to that, or say using retirement funds. So that's another large group. But primarily people that are looking for a very passive way to make a good yield. I can't tell you how many times somebody will come in and sit down with me and they just say, I'm tired of getting less than 1% at the bank. So,
right.
It's just somebody that wants to get a good return and be in a very passive way with very good protection.
Just a quick, this is Aaron, a quick question that was brought up that's asked quite a bit. Do we pool funds, or can people come in with another investor to take down deals?
Yeah, our policy has always been we definitely do not do pooled funds, and throughout the history we've basically required one investor per deal. That's basically how the model was set up, and it allows us to work a lot more efficiently, and especially with the new requirements that we'll probably touch on. But so basically, we do require one investor per trustee.
Craig, what is we have a lot of people that I would say that have over $1 million invested in trust deeds. What would you say their time expenditure is per month?
Geez, what you do, what you spend any time at all? Even myself, I have, a good portion of trustee. it's so minimal. It's just really signing docs for most of them. Now I know, if there's new people there, you don't get to that point right away. But I mean, you're spending, geez, even a few hours a month, I would say, on that kind of portfolio. There's just not a lot of time requirement.
I think one of the things that makes it really attractive right now too is just there's lots of volatility, and we'll get to that on another slide. So, but basically, we have people that have earned their money or are in the process of having extra money, and this has been a choice for them to put in, get a great yield without a lot of time expenditure, and it has safety.
Exactly, and you and I are probably good examples of the two. You're very successful, have bought and sold, hundreds of houses, and kind of you're in a point now where the passiveness and the consistency of the trustees is very good. I think I represent another group, as you know, when, I came over 17 years ago, I thought, oh, buying property, this and that, but, I'm not cut out for that. A lot of people, they think they want to get involved in it and, be doing the business, if you will. But, for me personally, that's not who I am. So this is a way I can be involved and get a very good return on my funds, yet in a very passive way, because it's just not my nature to be out there doing the business. And I think, a lot of people think they might want to do that, but, maybe they're not cut out to do it. And then getting a high yield on the same investment is probably a very good way to go.
Even if you are of the nature to where you are cut out to do it, it doesn't mean you always want to do it.
Yeah,
that's the nice part. At the end of the day, going, okay, well, I'm really excited about not doing it at this point.
Yeah, exactly, and I think you're a perfect example of that. At some point, you might not want to just, buy the houses and do the work and the fix up, and just take advantage of the good returns.
A lot of people now have saved money in retirement accounts, and we are not only loaning to people that are buying money in their different types of retirement entities. People that have the money are also investing in trustees. And do you have any idea what percentage of our trustees are funded by that type of funds?
We're going to break up when we're going to talk about the two programs, so we're getting a little ahead. The longer term funding of the trustees, more for the rental properties. If I had to just take a guess, I would say at least 50%, if not more, of the long-term rental properties are funded from IRAs or some sort of profit sharing, because it's just much more conducive to that type of investment, whereas the short-term loans, very rare to have a short-term loan funded by an IRA or profit sharing.
Yeah, just dealing with logistics of the paperwork path and all of that. It's easier just to stay parked in the trustee than to keep changing it.
Exactly.
Okay, well, we will cover that. Trustees as an investment as opposed to other things. I know one of the things that a lot of our investors like is that it produces a monthly check.
Yeah, exactly. Cash flow is just a fantastic reason to do it, because it's just very consistent income, and it can really supplement whether somebody's retired or getting close to that, or just numerous reasons to have cash flow, because a lot of investments don't really have cash flow. So this is a good one for cash flow.
Yeah, and it's also at a very high interest rate. Security, it's a first trustee always on a property, correct?
Yeah, and that's one of the things I tell people. We went over the fact that we don't have many trustees, but when you're in first position, I think a lot of people can even understand the concept that, okay, like the worst case here is there's this house, and I mean, I would actually own this house.
Right.
So you can go stand on it, stand in the front yard. I mean, if you got it back, you could rent it. It isn't a situation where all of a sudden the investment would be gone or lose, 50% of its value. I mean, the worst case scenario is the fact that you would own a house, and you would still have, numerous options with that.
Right, and you would have an equity position and somebody else would have probably put up money to get the loan and fix the property, and you would be adopting that position. It doesn't happen very often, and I guess it's worth stating that we never make a loan with that in mind, saying, okay, well, this is probably going to not work, so we'll end up with the property. We never do that. We don't have that type of borrower, and nor do we even have that type of trustee investor. They just want to
Yeah,
check.
yeah, no, that comes under as you've heard me say many times, we do loans, not situations.
Yeah.
And basically loans are just to investors, and that sometimes a property can have a lot of equity or make sense in terms of just the loan to value or that, but if it's too much of a situation, what I mean by that is you can just kind of go through. A lot of times they call me up and they say, I have a situation, and jokingly I almost say no right away, because we're not as concerned, or we're more concerned with having the protection along with the monthly payments to go along with it.
Right.
Not just the protection where somebody, might have to go months with that, why we go through any kind of foreclosure. We just don't want to deal with that scenario.
Diversification comes into play when you have a fair amount of money to invest. You're going to get involved in multiple trust deeds in multiple locations, probably with multiple borrowers. So there's safety in that type of diversification, even though it's under the same hat of I'm investing in trust deeds.
Exactly, and based on everybody's needs, you've covered kind of different locations, different borrowers, but based on what somebody wants to get started with, whether it's 500 or this or that, you break it down in a way. We would never say if somebody had 500,000 in a retirement account or something that they wanted to invest, we would never put that in one trustee.
Well, as a matter of fact, that brings up some of the changes.
Yeah, that's probably a good point.
Yeah, we'll talk about some of the changes that just have come down the pike because of Dodd-Frank and how it's affected the hard money loan business. There's a 10% rule now connected to what somebody can invest as far as their net worth. So go ahead and explain that a little bit.
Yeah, basically what they're saying is to invest in a trust deed, you would need to have the trust deed could be no more than 10% of your net worth, and that's minus the value of your home. So basically they've kind of really made it a lot more difficult than it was even a year ago. And what it's kind of done to us is the longer term loans generally are smaller, so those are probably right around 100,000. And per Aaron's question earlier, we put one investor in each trustee. So to invest in a long-term trustee, you're probably going to have a net worth minus your home of about $1 million. And the short-term program, most of those are probably around 250 plus. So to invest in the short term, you would probably have to have a net worth of minus your home of about $3 million.
And there's now a required investment questionnaire to where they fill it out. It's really trying to make sure that the trustee investment is suitable for them, given the net worth and given their experience.
Exactly. They want to make sure that the person has some liquidity and enough funds where, even though the payments are very consistent, you would never want to put somebody in a situation where if that payment didn't come in, they couldn't make their bills or, buy food. That's obviously you almost qualify somebody just like we would on the borrower side. You never want to put somebody in a situation where if they had to go without payments for 6 months, it would really upset, their entire living structure.
Oddly enough, this rule change really didn't affect our business very much. We were already dealing with that client, but because it looks like we've gotten a lot busier, maybe other hard money lenders have had trouble because their clients didn't have this the net worth necessary to continue being trustee investors. So this has really changed the game of trustee investing. This is not for small investors at this point. It really says you have to have $1 million net worth plus to participate.
Yeah, and unfortunately, I've made a lot of my friends that have been lending money through me for the last 25 years very upset with me. So
Yeah, and but that's it. That's just the nature of the what
it
the rules.
is.
It's
Yeah,
unfortunate. That's
it
true.
really is. But
Um, what do we loan on? What's the most common property type that we loan on?
we probably lend the majority of the loans we do, at least 95% or more, are just on single-family residences. We do some units. Everything is non-owner occupied, as we discussed earlier. Uh, no
And one of the
commercial.
reasons, I'll just mention one of the
Oh,
reasons we
sure.
do up to 4 units is that's considered residential in the financing world. So 1 to 4 units, you can get an FHA loan, owner-occupant buyer. So that's why we go up to
Yes.
4 units, because it's considered a house in the lending world.
Yeah, because financing is exactly the same as it would be on a single family. So
Right.
yeah.
We have appraisal done, and everybody's going to get title insurance to where they know they have a first trust deed. Fire insurance, now that's something that we're very careful on because we're always dealing with vacant houses.
Yeah, fire insurance, we definitely require, obviously on any loan we require fire insurance, but we insist that it's insurance for a vacant property. Every once in a while somebody tries to get by with a rental insurance policy, but we insist that the policy is a vacant policy, so we're sure we're covered. And then also noted on the long-term loans, because you're dealing with property taxes also. On each file we get what's called a tax service. So what happens there is if property taxes become delinquent, we're notified. So the fire insurance and the taxes and the title insurance, those are kind of the technical ways that we make sure that they're covered real well.
Okay. On the next slide, we'll just review the process for somebody qualifying. What we look at is we want to make sure they have cash reserves. We're not so much FICO score driven in saying yes or no, but if we have a FICO score that's very low, they'll probably be more investor, like you said, who's bought and sold several hundred homes himself. And at least a few times a year, he comes back and says, you just don't want to do the loan.
Oh, absolutely. If not more, which is really good, and it really helps out. When you do get somebody that is newer and is qualified to do it, but maybe they get started on a property, and Rick will go out there, and you can just see there's a reason not to do it, and that's just the best thing we offer is, and this kind of goes over to the borrower side. We have the ability and the experience to talk somebody out of a deal that really isn't a good deal before they get started on it, and I think that's invaluable.
Well, it's also invaluable for the person that has the money to understand how often we say no to something that maybe another lender would say yes to. We're not desperate to make a loan. We realize that it's much more important to make a good loan than just another loan.
Oh, exactly. And a lot of times I do skip over to the borrower side, but I can't tell you how many times one of our borrowers, who knows how I treat them when they're trying to borrow money, has said, you know what, once I'm done, I want you to invest the money for us.
Exactly, because
So
the process is different.
exactly. And another thing on the appraisal, I think, which is important, we kind of have a relatively, wide lending area, all of Southern California, but we do have appraisers in each particular geographic zone, so they have their long-term experience in each area, so they're able to know the little ins and outs of each neighborhood, whether it be the Palm Springs area or down in San Diego or Lancaster, Palmdale. We kind of have appraisers in all those areas so that they have general knowledge of the area, not just looking at numbers.
I think it's important, and I'll just say this from an owner's point of view. that if you have money to invest in a trustee, I can guarantee you, you will not do a better underwriting process on your own than will the team at the Norris Group. That's the bottom line. It's the safest way to go about it. Craig, let's talk about the programs that we've got. We've got about 15 minutes left. Their prices went down in California, and we realized that there was really a shortage of funding available for investors. Fannie Mae and Freddie Mac, one of the reasons why I went back to Washington, D.C. was try to stump for investors and get the willingness to loan us more money, and that never happened. So over 3 years ago, we created a program specifically to meet that need where somebody can buy a property and keep it as a rental. And so let's talk about that program.
Yeah, we started that probably about 4 years ago, and I think that probably, excuse me, comprises maybe about half of the portfolio that we have now. And it was amazing to think after, say, what, '06, with those high prices, that just a couple years later, investors were going to be able to buy properties in California that would actually cash flow, and not only cash flow, but at 9%.
Right.
And it allowed them to buy inventory and hold it. And boy, some of those people that have started, 3.5 years ago, they've already seen enormous jumps in their inventory. And one question I get a lot on the money side about from people on that, they say, well, what quality borrower would pay 9%? And I can just tell you, even if you've tried to do an owner-occupied refi, it's not that easy in this market. And to get if you're somebody that's, it's going to be a non-owner occupied rental, you own 20 or 30 rental houses already, I can just tell you there's just not financing available for that person. So
right, it doesn't matter what their application looks like. It's after number 10, it's virtually impossible to get standard loans.
Yeah, I mean, there's people that search out and maybe get a portfolio lender here and there, but as we both know, I mean, we have a client that probably had, I don't know, 30 or 40 houses free and clear and several $1 million in the bank, and they actually tried, and we had done some refinances for them because, once again, it comes down to that common sense factor. For us, that was like, geez, you want to, we're lucky enough to get your business, where a bank would say, you're not qualified. So that's just one of the questions I get.
Most of these properties come to us, they're rent ready. They've been purchased, they've been rehabbed, many times already occupied and rented before we end up doing this particular program.
Yeah, exactly. And the people see, this is a note I wanted to get out. When you're dealing with two different programs, and we'll get into the flip program after this, but if somebody's going to buy a house and fix it up to resell, they're going to go in and do everything, top of the line, just as nice as they can do it, because they're going to go to resell it. Now, when they're buying a rental, that's not necessarily the case. I mean, they're definitely going to, fix it up and do what they need to do. But when you're working with us, you'll notice that, like, on a lot of the rental properties, the property's in average condition. On the flip properties, the property might reflect in good condition. But what the appraiser will do, he will deduct the average condition house, will not appraise for as much as the flipped house does. So, that's just getting used to. If people aren't used to appraisals, I usually will, bring that point up, just because that's what somebody that's going to rent a house is going to do.
Yeah, many times we're dealing with properties that are in the Lancaster, Victorville, Hemet areas, and they may look like, okay, well, there's not much lawn there, or the bottom line is, I guess you take a look at the success of the payment history of that whole program. We have closing in on $30 million of that. Have we ever had a foreclosure in that program?
Not on that program, no.
Okay. So people that are buying to hold those properties, and that's one of the things that we look for is, we have the same criteria, experienced investor and so forth, but a lot of times the rent far exceeds the payment. And so, again, a foreclosure would be I'm swapping my interest check for their rental check. And it literally wouldn't be terrible if it happened, but it hasn't happened yet.
Right, exactly.
Okay.
Exactly.
Most of these loans people were intending to keep for a long period of time. That's the difference between this program and the next one we're going to talk about is this was designed to build equity and have a cash flow on the way there.
Right.
And did we have many competitors when we came up with this program?
No, once again, I mean, that was one of the nice points about it. I mean, you either had bank-type financing, which was virtually impossible, or you had short-term financing from, some hard money companies, but nobody had a program that extended as long as ours did for the 8 years. And it's always been our business model. Our business model is to be, even the fees we charge and everything else, we're on the lower end because we'd rather make less on the best clients and, just do more of them. And this program fit right in, and that's why the payment history's been so good, because there was a lot of awful good clients that just could not get financing, and this program was perfect for them. And that's kind of where a lot of the turndowns come in, on this program, because just because somebody, say, has a rental house, they don't necessarily fit our model of who we're looking to lend to.
A lot of the properties that come in on this program are free and clear when you do the loan.
Yeah, numerous ones are. I mean, I'm working on a group now that's 11. So inherently, I think people out there can understand, you have somebody that's paid cash for 11 houses.
Right.
That guy's qualified. I mean, you know what I mean?
You're going to refi out probably $1 million of liquidity.
Yeah, so
cash flow.
Exactly.
There's an example on a property in Hemet, and this is kind of typical, where you're at 62% loan to value. The payment the investor is receiving is $442.50, and it rents for $1,100. I mean, that probably a very generous example from payment to rent, but there's going to be a spread there, or we'd have to have one heck of a good reason to make the loan. So that's the safety, is that a foreclosure on this particular property, you would, instead of be getting $442, you'd get $1,100 and deal with the hassle of ownership of that property.
Exactly, and that answers the question that some investors may have. Well, geez, I'd like something in Orange County or what have you. Well, our investors aren't going to buy in Orange County, because even though this, like you say, this probably might not quite be this spread now with the way prices are going, but they're buying in these neighborhoods because these areas were devastated in the downturn, and they're able to cash flow properties to a point where it was almost unthinkable, 4 years ago.
Yeah, way below replacement cost.
Yes.
All right, let's talk about the other part of the business, which is, again, a good share of our business. And this is the property that's bought in pretty rough condition usually, and then gets a transformation and is resold, the rehabber program. So what is the difference in this program as far as the money required and also the reaction time? I guess we ought to talk about when someone's saying going to be putting up $200,000 to $300,000 per loan on this, and the trustee is written for a year and so forth. What do we expect on their side as far as saying, when we contact you, what is the process and how quickly do we need them to respond?
Yeah, versus the 9% program, where generally you do have quite a bit of lead time to go look at the property or what have you. When we're dealing with these flip-type deals, as you mentioned, generally the borrower is able to get the deal because they've told the bank that they can close it in, say, 10 days. So the basic process now, the majority of these loans just go to existing investors. so they're used to the process. But for people that might want to get involved with this program, it's important to know that the process is probably going to go something like this, although not necessarily this fast every time. But let's say they're interested and they've qualified, so we know that they can do a particular loan, say for $250,000. I might send them an appraisal, say at 2 o'clock in the afternoon, on a Monday. Mm-hmm. And generally what I'm going to tell them is I'd like you to be able to, by tomorrow morning, which would be Tuesday morning, at least give me a thumbs up that, what, this looks good, but I want to just do a little bit more, research, or if you get a chance, go look at the property. So as long as they give me the thumbs up, then I kind of would tell them, okay, I mean, absolutely, but I really need to know now in 24 hours that you're 100% ready to go. Because if not, I just have to put somebody in it, because we're going to have to be, we're not dictating this, closing the escrow is dictating this. So, within the next 24 hours, they would have to give me like a final, yes, this looks good. And then from that point, I mean, it might be the next day or so we're sending them out docs and, needing a check in a day or two after that. So unfortunately for new people, that process is very quick. But it is what's necessary, because that's the kind of pressure that we're under when we're doing this. I mean, we're under the pressure to close these loans, because that's how a lot of the clients are getting these good deals, is by telling them they can close quickly. So
yeah, that's how the whole business is arranged, is to fund loans. And whenever somebody decides to take a discount, by the way, that's what our clients do, is buy these homes at a discount. I want to emphasize a point that you made. You said most of these loans go to existing investors. In other words, what Craig is saying is that we have a group of people with money who want trust deeds, that trust us, that react quickly within that time frame. And how you get to be one of those investors is you learn to make decisions based on our underwriting process, that you learn to trust us. And that may take a little while for you to get to, but if you really want to put a fair amount of your money with us at some point, that'll be part of the process, is that we have to be on the same team, knowing that we can't disappoint our client. We can't go to the 9th day of a 10-day escrow and have somebody say, well, we decided not to fund it. That's just literally unacceptable. And so that's why existing investors get such a lion's share of the business.
yes.
Okay, time is short. We got 4 more minutes. Let's talk about the go ahead, Aaron, go through the other pictures there. This is just the process. This is a home that we did as a company. That took about $60,000 repairs, as I recall. We bought it at a big discount. We sold the property and made a healthy profit. The neighbors, by the way, were really happy we showed up. They had an empty pool next door, and we transformed this home into a beautiful home. And when we sold it, it was the highest comp in the area, which didn't hurt anybody's feelings either. That's literally the business we're in, transforming properties that are ugly to something that's really good. What's also coming now is the ability to fund construction loans. So Craig, let's talk about that program. The yield on the first program was 9% on a trustee that goes 8 years, 11% on the buy and sell, and now this is 12% to participate in a construction loan.
Yeah, 12%, and basically the quick parameters on that, what we require before we even get involved, and it all comes down to that liquidity question, is the borrower must own the land free and clear. They need to have their plans and permits. And at that point, then we'll do the loan, usually covering, 100% of the hard cost, and there might even be a little in there for some of this other at the end. But we'll fund the loan at that point, and then the new requirements with the new law, it has to go to a third-party fund control company. Mm-hmm. So there's a third party that handles all the disbursement, and so far it's worked out very well. They go out, they take pictures, they give us the recommendations of how much we should release. So there's a pretty tight, pretty tight window on the people doing it. And it's the type of thing, if somebody isn't comfortable with, I don't know if there's an easier way with fund control, but, we're very comfortable with it. And if somebody doesn't want to use our fund control, we just couldn't do the deal.
Right, and it's a built-in safety factor because they do all of the checks of the property and make sure that lien releases occur and all that, and the fee that they do it for is pretty remarkable. So that's just part of the next niche in our loan business. It pays a little higher interest, um, and it'll be a niche that we feel comfortable with for certainly the next few years. Kind of time to wrap up. The First Look program. Talk a little bit about how somebody might get involved in investing in our trustees, Craig.
Yeah, basically, hey, Aaron, I know you're there. You've kind of designed that. Give them an update real quick on how that works.
What we've been doing is the Department of Real Estate investor questionnaire we get filled out. We get it back from the trustee investors, potential trustee investors. We put it on file. We put them on an email list to where they get a 24-hour advance notice when we have trustees available. This also helps us serve people better, so we're not getting inundated with questions from. We have a pretty large list, and this way we know up front when people are calling in if they even qualify. So keep in mind that we're having to reference this questionnaire every file. We have to put the questionnaire on with every trustee in case we're ever audited by the Department of Real Estate. They're going to be looking for this form. So we have to include it in all of our paperwork. So we needed to have it on file.
Very good.
Okay. Aaron, do we have any questions, or are we out of time?
No, we can go as long as we want. I've been answering questions along the way. One of the questions that did come up, as far as the pooling money, do we fund deals with LLCs?
As far as a borrower?
No, as far as a trustee investor, can it be an entity?
Yes.
Sure.
Yeah, it could be an entity. Yes.
So we've done charitable remainder trusts, family trusts, corporations, anything we wouldn't do?
As long as it's a legal entity, I think we've been good.
Yeah, and we have documentation that supports that who's ever signing has the authority to do so.
Okay, if anybody else wants to send in a question,
by the way,
I can take it.
I'll just mention that a lot of times our borrowers will also be under an entity. So when you're loaning money and you see some LLC, I wouldn't get worried about that. That's a very experienced person understanding they need to protect themselves with another entity. So I'd say a lot of our loans come under the S corporation or an LLC or a limited partnership, even a land trust. So we have very sophisticated people that we loan to, and that's very common.
Are all of your investments in California?
Yes, everything is really in Southern California.
Okay, somebody who's Laura is asking, what is the process the Norris Group went through to be a broker, and who regulates us, and what credentials do we have?
Well, the DRE regulates any broker in California. In California, you do not need a loan broker's license to do this particular type of loan when we loan to investors. We have a real estate broker's license. We are with the good, the Better Business Bureau. You can also check with the DRE about any complaints or anything. You'll find that we have a perfect track record.
Perfect. One more. If a borrower does default, what services, if any, do you provide, and can you talk a little bit about the process?
Craig, you want to do that?
Yeah. Okay. Basically, what I tell people, if you do get in that situation, there's kind of two ways to go. If the investor is more experienced, they might just decide to kind of take over the whole process themselves and deal with it on their own start to finish. Probably the most common person that we have would probably want us to be involved. So kind of using the last one we had as an example, I mean, we're able to, tell the person, okay, we're going to start the foreclosure with this particular company. They're going to handle the foreclosure. In this situation, there was a tenant in the property that didn't want to leave, so we actually were able to refer them to an attorney who could do the eviction. Once that happened, this person was a real estate agent, so I had recommended somebody that could probably help them fix the house. they chose to use somebody and then actually list the property themselves. So I guess the answer to that is we kind of supply as much as we can or as necessary, but I do let people know they are responsible for the financial side of that. So, they're going to pay for the foreclosure, maybe around, start to finish on just the foreclosure process on a $150,000 loan might be $2,500. So we can be as involved as somebody would want them to. It's just that they would be responsible for the money part of that.
Right. We can also direct you toward, if you end up with the property that needs repairs, we can direct you to people that can give you bids, brokers that can sell it. So it's just, we don't just leave you out there and say, well, good luck. We deal with hundreds of properties a year. This would not be hard for us to deal with. It would just be one more, and you could decide to keep the property too. But again, we're talking about the odds of this are much less than 1%. But it's good to cover. But we're not going to leave you alone, or alone rather. We're going to help as much as you want us to help.